You know what's interesting? The market doesn't actually hurt intelligent people. What gets them is when their emotions take over their thinking. I have sat across from surgeons who can operate for hours without any stress, but show them their portfolio down 20% and you can see the worry in their eyes. I'm Khalid Shamim. I have spent 17 years helping successful professionals in the GCC manage their wealth. What strikes me is how often I see the same patterns repeating. These are brilliant people who run companies, perform complex surgeries, design buildings, yet when it comes to their own money, they make decisions they later can't explain. It's not about being careless or uninformed, there's something else happening here. Neuroscience research shows something important about how we make financial decisions. When money is at risk, the emotional parts of the brain become active, especially areas involved in fear and loss. That's the same system designed to protect us from danger. So when markets fall, your brain often responds emotionally before it responds rationally. It's not weakness, it's biology. This explains why I was so wrong about wealth management when I started out. Back when I started in 2008 at ABN AMRO, right as the financial crisis was happening, I had this idea that wealth management was all about technical expertise. Find the best investments, time the markets perfectly, get everything right. I was completely wrong about what mattered most. Markets don't move because of company performance alone. They move because of how people feel about that performance. And feelings, especially around money, follow patterns most of us never notice. Take this client of mine, runs the finances for a major retail chain here in Dubai. When we discuss his company's investments, he's methodical, patient, thinks in quarters and years. But with his personal portfolio, he becomes much more cautious. He'll keep investments that are down, thinking they might recover. Yet when something shows even a little profit, he wants to secure those gains right away. One day I had to ask, help me understand something. You would never run your business this way. What's the difference here? Long pause. Then he said something that stuck with me. With the business, I think. With my money, I just react. That's the key right there. Money doesn't activate our thinking brain. It activates our survival brain. And unless you design around that reality, emotions will quietly take control of your decisions. This creates two completely different ways people approach investing. Most people live in what I call the reactive circle. Your decisions are driven by whatever you felt last. Fear when things drop, excitement when things rise, hope when you are losing, anxiety when you are up because you are scared to give it back. You buy what's already gone up because it feels safe. You sell what's gone down because it feels dangerous. You hold declining positions because selling means recognizing the investment didn't work out. You sell winners too early because you are terrified of losing what you have gained. Every decision is a reaction to the last move the market made. I saw this happen perfectly in March 2020. Markets dropped hard. I had clients calling me really worried. Khalid, I can't handle watching this anymore. Just sell everything. These were the exact same people who 6 months before were asking me how they could invest more money because everything was doing so well. The ones who stayed calm, who recognized that worried feeling as just a feeling, not something they had to act on, they recovered. They actually made good profits. The ones who acted on their emotions, they sold when prices were lowest, bought back when prices were highest. I have seen it so many times, it's almost predictable. Now, the second circle, the intentional circle. This is where wealth actually gets built. In the intentional circle, you make decisions based on a system, not a feeling. You know your risk before you enter. You know your exit before you buy. You understand that temporary losses are part of the process, not personal failure. You're not smarter than people in the reactive circle. You are just operating from a different place. But what keeps people stuck in the reactive circle? I see three main barriers that most people can't even see. The first is the fear barrier. A few years ago, I met with an entrepreneur who had built his business from scratch and sold it for substantial money. Successful guy, hardworking. But throughout our discussions, he kept mentioning the same thing. I need to recover what I lost in 2008. That was 2025. So many years had passed. That loss has created a barrier in his mind. He was so afraid of losing again that he only looked at safe options, which meant he was losing to inflation every year, which meant he was actually losing money, just slowly. The second barrier is the ego barrier. This one is subtle. It's when you can't admit you're wrong, so you hold declining positions forever, hoping they will eventually prove you right. I have seen people hold investments down 40, 50, 60%, not because they believe in the company anymore, but because selling would mean accepting they made a mistake. The third barrier is the comparison barrier. Your friend tells you about some investment that made them money, so you drop your own plans to chase the same thing. I see this happening all the time here in Dubai. Here's what makes these barriers so tricky. You can't recognize them in yourself. They don't feel like mistakes. They feel like smart thinking. They feel like you are being responsible and careful. But they are not. They are your emotional system trying to keep you safe. And in protecting you from short-term pain, they are also protecting you from long-term growth. Let me show you what this actually cost. I had a client come to me with a portfolio that had been sitting in cash for 3 years. 3 full years. He was waiting for the right time to invest. I asked him, what would the right time look like? He said, when things are more stable. As we know, things are never stable. That's not how markets work. He knew that intellectually, but his nervous system couldn't pull the trigger. Over that period, markets recovered strongly and he wasn't participating. He missed all of it because he was waiting for a feeling of certainty that was never going to come. That's the real cost of the reactive circle. It's not just the poor decision you make, it's the good decisions you don't make because your brain is trying to protect you from discomfort. Now here's what this gets interesting. Most people think the solution is to learn more, read more books, follow more experts, get more data. But that's not it. I know people who can quote Warren Buffett, who understands technical analysis, who read every report, and they still make emotional decisions when it matters. Because knowing what to do and actually doing are completely different things. So how do you actually move from the reactive circle to the intentional circle? Here's what actually works. First, accept that you are not purely rational. None of us are. Not me, not you, not the smartest person you know. We make emotional decisions and then create logical reasons to justify them afterward. Once you accept that, everything changes. Because now, instead of trusting your gut completely, you start questioning it. Is this feeling giving me good information or is it just trying to protect me from discomfort? Second, build a system that works when you don't feel like following it. Well, this is critical. Your system has to be simple enough that you can stick to it, whether you are scared, excited, bored, or tempted. Here's mine. When I evaluate any investment, I ask 3 things. What's the maximum I can lose? What's the realistic return I can expect? Can I sleep at night with this position? That's it. Not complicated. But it forces me to think about risk first, return second, and emotional comfort third. Most people do the opposite. They think about return first, ignore risk, and then can't sleep. Third, get comfortable being uncomfortable. Every good investment decision I have made felt slightly wrong at the time. Not reckless, not stupid, just uncomfortable. Because good decisions often mean doing the opposite of what feels natural. Buying when everyone is scared feels uncomfortable. Holding through market ups and downs feel uncomfortable. But that discomfort is actually a signal. It's telling you are doing something different from the crowd. And in markets, being different from the crowd when you have a solid reason is usually where opportunity lives. Let me make this concrete with three principles. One, define your risk before you think about returns. Every time someone asks me, what can I invest in to make 20% a year? I know you are thinking backwards. The right question is, how much am I willing to lose for that 20%? Because here's the reality. Higher returns always comes with higher risk. Always. Anyone who tells you otherwise either doesn't understand markets or isn't being honest. But here's what most people miss. You can control your risk. You can't control your returns. The market will do what it does. But you can decide how much you are exposed. You can decide where your exit point is. You can decide how much of your portfolio is in any single position. That is control. That is power. Two, time beats timing. I have never met anyone who consistently times the market. Not once. But I have met plenty who have built serious wealth by staying invested through multiple cycles. They didn't try to catch the bottom or sell at the top. They just stayed in the game long enough for time to work in their favor. Three, your biggest risk isn't the market, it's your own behavior. I have seen people lose more money from panic selling, chasing performance, and holding declining positions than from any market crash. All behavioral mistakes, not market mistakes. And the only way to fix them is to build a system that protects you from yourself. Now, this brings me to something I noticed early on. Most investment products are designed to appeal to your emotions, not solve your actual problems. They are marketed on returns with big numbers and past performance. You'll hear things like, look how much this made last year. But they don't talk about risk. They don't talk about what happens when things go wrong. They don't talk about the emotional experience you will have. When you invest based on how something makes you feel, safe, excited, smart, you are setting yourself up to make emotional decisions later. Because when that investment drops, you'll panic. When it goes up, you'll get excited. When it goes sideways, you will get bored and chase something else. I saw this constantly at conventional banks. Client would invest based on past performance, and the moment things got volatile, they would come out. The investments weren't necessarily bad. The problem was they didn't really understand what they were getting into. They bought based on how it made them feel rather than understanding how it actually worked. This is where structured approaches changed how I work. I want to explain why certain tools address almost every behavioral issue we have talked about. Take structure notes, for example. They force you to define your risk upfront. When we build one, the first conversation isn't about returns, it's about downside. How much of a market drop can you handle? 30%, 40%, 50%? We set that protection level first. Then we build everything else around it. This is the opposite of how most people invest. They buy something, hope it goes up, and panic when it drops because they never thought about the downside. Second, they reduce emotional decision making during the investment period. Once you are in it, there's no daily decisions to make. No, should I sell today? No constantly checking prices and feeling anxious about every movement. You know your terms, you know your timeline, you know your protection level, and you wait. This is huge for people who tend to make impulsive decisions. It removes the opportunity to act on emotion. Third, they provide transparency because the rules are defined upfront. No black box, no trust us. You can see exactly what needs to happen for different outcomes. This addresses that certainty barrier. You're not investing in hope, you're investing in a defined structure with clear terms. Fourth, they can be customized to your actual situation. not some generic risk profile, your specific needs, your specific risk tolerance, your specific timeline. I have built structure notes for clients who needed income, for clients who wanted growth with protection, for clients who wanted market upside but couldn't handle any downside. Same tool, completely different structures. But here's the deeper insight. The reason structured approaches work isn't just because they have got good financial tools, it is because they align with how your brain actually works. Remember when I said your brain treats money like survival, not maths? These structures work with that, not against it. They give you the emotional comfort of knowing your downside is protected. That comfort allows you to stay rational when things get volatile. They provide clarity, which addresses the fear of the unknown that keeps people in cash shit or in safe options that lose to inflation. They are designed around human behavior, not just financial theory. Let me bring this all together. Everything I have shared comes down to one insight. Your success in building wealth has less to do what you invest in and more to do with how you make decisions under pressure. The markets will always be volatile. There will always be crashes and booms. That's not changing. What can change is how you respond. And the way you change that isn't by learning more, it's by understanding yourself better, by recognizing your patterns, by building systems that work even when you don't feel like following them. The people I have seen build real lasting wealth aren't the smartest. They are not the ones with the most information. They are the ones who figured out how to get out of their own way. They moved from reactive to intentional. They broke through barriers. They built systems that protected them from their worst instinct. And they stayed in the game long enough for time to work in their favor. That's the whole game. I work with high income professionals and expats across the GCC, people who have done well but know that managing wealth is a different skill than building it. People who want clarity, not complexity. If you have been sitting on cash waiting for the right time, there's no right time. There's only the decision to start thinking differently. If you have been chasing returns and feeling exhausted, there's a calmer way, more structured, more aligned with how you actually want to live. The market doesn't care about your feelings. It doesn't care about your hopes, fears, or plans. But your decisions do. Your decisions are where feelings become actions and actions over time becomes results. So the question isn't what is the market going to do? The question is what I am going to do regardless of what the market does. Answer that, build a system around it, and you'll be ahead of most people out there. Thanks for watching.